All right, so the topic which we shall discuss today is monetary and fiscal policy. It's a very hand-on topic. It's a very applied economics topic. This is the, yep. Right, so the topic which, as I said, that it's a very applied economics topic, that the monetary and the fiscal policy are the tools which the state, the government, the central bank use very often, or rather more than often actually, to monitor, to run, to maneuver the economy. So that's what we shall study today. What is monetary policy? You can see that the monetary policy is carried out by the central bank of the country. The central bank could be Bank of Finland, Suomi Pankki in Finland. It could be Riksbank in Sverige, in Sweden. It could be Bank of England in the US. No, in the UK, sorry, what happened to me? It could be Federal Reserve System, because there is no one central bank in the US. They have a Federal Reserve System. When you see the dollar, it says Federal Reserve. So depending upon the country, there's always one central body, the apex body, which is taking care of the monetary policy of the country. And the monetary policy is that how you can have an impact on the economy by fine-tuning the supply of money and cost of supply of money. So by changing the supply of money, you can influence the economy. You can make an impact. So sometimes you can decrease money supply, sometimes you can increase the supply of money depending upon the situation. You make your judgment. And who runs the show? It's not under any ministry, because it is run by the central bank. So usually the head of the bank, like for example, in Britain, they call it chancellor of the chancellor. In many countries, it's called governor or chief of the central bank. So the CEO of the central bank, who is not usually a politician, he is a technocrat, she's a, usually they are economics and finance PhDs who have worked in IMF, and since they work for 25 years and now they're in the mid-50s, and then they come and assume the role of the head of the central bank. So it's a very high position. The good thing is that it's not run by the politicians often, so otherwise they will. Yeah. It's a professional position. They control the quantity of money in an economy, and they use different channels that how the money would be. They not only fix how much supply of money would be there in the economy, but they also make a roadmap, the channel, the route, that in which sector, how much money supply would be required and how much it will be supplied. In some sector, it could happen that they are overall increasing the supply of money, but in some sectors, they are actually decreasing the supply of money. So they also do this qualitative job as well. They use the judgment as well. And it also involved the cost of money. Now, when I say the cost of money, it basically means the rate of interest. The rate of interest is the cost of money, is the price of money. Like when I buy this phone, I pay a price. When you take an apartment on lease, you pay rent. Rent is the price of the property. So same way, when you are borrowing or lending the money, there is a price involved, and that price is called rate of interest. Yep. So that's something very important. At any point of time, if you have any question, you can just raise your hand and ask me. Monetary policy consists of management of money supply and the interest rate, as I said, aim to achieve. And why do we run it? Is it for the fun's sake? No. We want to run the economy and we want to achieve some broad macroeconomic objectives of the economy. And what are those objectives? We want to control inflation, because there's always a fear that if there is no check on supply of money, we may end up having too much of supply of money causing inflation, or we can have too less supply of money which cause recession. It could be possible that your economy is growing, but supply of money is not corresponding to the growth needs. It's like a child is in adolescent age, is growing age, gaining height, okay, but there's not enough food, or the food is not according to it's not a healthy food. You get my point? So when the economy is growing, you need more money supply. Economy, if I can use a metaphor, economy is like a human body, and supply of money is the blood circulation. Amount of blood and the speed, the velocity at which the blood circulates. If we have too much blood, too less blood, and for the given amount of blood, if the circulation is too fast or too less, that can have an impact on the health of the human body. The same way, if we have too much of money supply or too less of it, or if the money flows very fast or very slow, that can have its own impact on the economy. All right. So we want to, a very important, if you guys at any stage joins some political or some top position where you are a policymaker, you will, at the country level, you will find that checking the inflation is very, very important. If inflation goes unchecked, it can be catastrophic for the economy. Growth is very important. The economy needs growth. Some economies are growing fast than the other, okay? And the growth requires supply of money. If the growth rate is changing, which it is, then the supply of money has to correspond to the growth. If there's a mismatch between the economic growth and the money supply, then it's like giving very heavy dose to a patient who requires a mild dose, or giving a mild dose to a patient who requires a heavy dose. So it's like, how to say it? It's like diagnosing, right? So the money supply should diagnose the economic health, and then it should change accordingly, right? So money supply has to follow the growth, the economic growth. And the third very important objective of any economy is having enough of liquidity. Means lots of cash should be there in the economy, so that the state can pay its debts and it's make its payments, right? Having the liquidity is very important. If the state doesn't have the cash, it will not be able to import the necessary things from the other countries because it doesn't have money to pay, right? So yeah, growth, liquidity, and very importantly, stability. The macroeconomic stability is very important. So if you are keeping inflation in check, if the economy is growing, all right, it doesn't grow in zigzag, not haphazardly. If I were an economist, I would not like that 1 year the economy grows at 9% and next year it grows at 2%. No. I would prefer 4% growth rate if it goes in a stable fashion, because instability can cause speculations, and speculations can backfire, right? So therefore, the growth, stability, liquidity, inflation, and how it have an impact on the consumption. So these are some of the macroeconomic objectives which any country, every country wants to achieve. You are a rich country, a poor country, a developed, developing, emerging, whatever, controlled, capitalist, welfare, you need to control, you need to achieve some macroeconomic objectives. How this policy is implemented, I would not touch it yet, but Soon you will see. I'll show it to you. Yeah, so as I said, the monetary policy is about the supply of money and the cost of it. And the cost is basically the rate of interest, in which you want to check, control, you want to promote growth, which includes output, employment, and at the same time, you want to keep check on inflation, which could be very dangerous, okay? Not only inflation, you also want to check the recession. I think I said a couple of lectures before that if I have to make a choice between the inflation and recession, I would choose inflation. Yeah, because inflation can be cured technical measures, but the recession has a lot of impact on, it has very serious psychological impacts. So yeah, so you can be following expansionary policy or contractionary policy. When you want to increase money supply, you follow the expansionary policy. And when you want to diminish the supply of money, you follow the contractionary policy. So it's expansion. I'm using these words because you get familiar with the jargon that we use in the economy. I'll come to this. So we go on. This is the first tool which the head of the central bank uses to check the supply of money. And this is called open markets operations. In the open market, what happens is that if the central bank thinks that there should be more money supply in the economy. So you are a head of the central bank and you see with some kind of microscope that there is less supply of money in the economy. Question is, how would you increase it? The answer is the central bank starts buying financial assets from people, from companies. Financial assets means, you know the financial assets, the treasury bonds, you know the bond, many people buy the government bond. The government bond is that, for example, if I'm the state and I say, all right, folks, do you have some spare money? You say, yes, we have spare money. All right. Okay, I give you 3% rate of interest and you give me each of you 100 euros, one paper. So take as many papers you want. Each is having a price of 100 euros and I would pay you 3%, 4% rate of interest a year. Okay. And the rate of interest is usually less on the bond. You know why? Because it's issued by the state. So the risk of default is almost zero. You get my point? So what you do, you have some spare money, you give it to me, I give you this piece of paper, and after every year, I give you 3% rate of interest. As simple as that. Now, so you guys have these government bills, bond, what I can call it. In finance, the definition, sometimes I use the word bill, sometimes I use the word bond, bill and bond. Bill and bond are basically the same thing. The only difference is that if the time of maturity is less than a year, it's called bill. But if the time of maturity is 365 days and above, it is called a bond. Make sense? You know why 364? Because 365 days become 1 year. So if the state is borrowing from you by issuing these bonds or the bills and giving you a promise that, okay, folks, I gave you 3% rate of interest. Are you okay with this? Well, if you're okay, you pay money to the state and the state issues you the bill. It issues you bill if the period of maturity is less than a year. But if it is more than a year, 1 year, 2 years, 10 years, then it is called bond, right? So in finance, we have very clear distinction between the short period and the long period. The short period or the current period is max 364 days. and the long period or the non-current period is 365 days and above. Above could be infinity. Make sense? Yeah. So the state says, all right, now when the state realizes, state means the head of this central bank, when he or she realizes that there should be more money supply in the economy. And then he approaches people and the companies, hey folks, you have the bills, do you have them? Yes, we have them. Give it to me, I give you cash. So what happens? The movement of those certificates start going away from you to from the public towards the central bank, and the central bank start giving money to the people and the companies. And when you guys have the money, what would you do? Well, you will consume, you will invest, you will do whatever you want. So thus, the supply of money can be increased by the central bank. On the contrary, if the central bank feels that there is too much of money supply and it is going too high, it could cause inflation, it can lead to the fall in the value of euro if we are we need to take away the money from the people. It will not rob your money from households. it will simply issue the bills or bonds to you, what we call as the financial assets, right? So the central bank will start issuing you. So now the papers are going away from central bank to the public, and cash money is coming from the public to the central bank. And this transaction goes on till we reach at the optimum level of money supply in the economy. And then the state bank is convinced, yes, the central bank is convinced that, yes, I think this is the money supply which we want economy to have. This is called open market operations policy. When the state is dealing through the securities, through the financial assets. See, I'm using different words so that you can get familiar. Securities, financial assets could be bills, could be bond. If it is for the short period, we call them treasury bill. If it is for the long period, we call it treasury bond. The word treasury is used as a prefix. It shows that this belongs to the state. You get my point? Because these bills and bonds can be issued by the private companies also. So the bills and bond issued by Nokia are not treasury. They can't use the word treasury. But bills and bonds issued by the Central Bank of Finland will be using this phrase treasury in it. Treasury. So that shows that these are issued by the central bank, that is the state, that is the government. Make sense? The operation is very simple. You guys have too much money. Okay, you are the people, I'm the central bank. Okay, you have too much money supply. Okay, I take it away. How do I take it away? I give you the bills and bond, and you give me cash. You give me money. And next time, I think you have less money. Okay, because of less money, you don't buy the food in the cafeteria, and cafeteria has to keep people sack people because they can't give salaries because you guys don't have cash to buy lunch. And if I want to encourage the more expansion in the economy or in the restaurant, what would I do? I would buy back the bills which you have, and I give you cash with the interest. And then what happens? You invest. So if I want to be expansionary, if being head of the central bank, if I have the intention that I want to, we use a phrase called stimulus. If I want to promote economic activities in the economy, then I would buy bills, bonds, that is securities from you, and I give you cash, money. And if I want to take away this extra surplus money from you, because that can cause inflation, Because if you have too much money supply and the food quantity is same in the restaurant, what will happen? The price of food will go up. Are you with me? I'm making a very micro example that you have too much cash in your wallets, okay? And you all want to eat food, lunch here in restaurant, but the restaurant has a fixed supply of food. What will happen? There'll be too much of rush on the restaurant. And because they have the same given amount of supply of food, then they end up increasing the price of food. So what's the fun? So instead of this thing happening, I take away this extra money from you. Not by stealing, not by robbing, but by issuing bills or bonds. Bills, if I want to borrow from you for short period, bonds, if it is for the long period. And what is the cutoff point between short and long period in finance? 364 days. Make sense? Any doubt, any query you have, any question?
So what is the difference between bond and security?
Well, they all are called securities. Securities can be for the short period. If it is for short period, it's called a bill. And if this security is for the long period, then we call it bond. And long period and the short period is 364 days cutoff point. Up to 364 days, including 364 days, it's called short period. 365 days and above is called long period in finance. Yeah, did I answer you?
Yeah.
Sorry.
Specific example of such bills or bonds, because I cannot understand how the government just can issue bonds bills to a person who doesn't make any loans or something.
Yeah, good question. Let me take a pause. Yeah, so then there is a almost economic bankruptcy of the country. Then I think you have to take away all the money from the economy and replace it with some other money. You're right, in Zimbabwe, for example, not in the distant past, in the recent past, there has been inflation 150% on daily basis. So why would people have faith in the money? Nobody would have faith in the money. And there are some situations when people in the country stop using the currency for the same reason you said. And then they have to invite the dollar program, in which in your country, you only accept dollars because you don't have faith in your own currency. So in the rarest of rare cases, it can happen. Yeah. Yes, the lady raised hand, but I, no.
I was thinking about that. Person has enough money or too much money. It's the same thing that when he is going to have too much money, the bank will say you need to buy some stocks or we need to charge more of keeping your money in our bank. Is it the kind of same thing that the bank is pushing you to?
Yeah, bank is giving you an incentive. What's the word in English? Enticing, entice, allure. Bank doesn't force you, but basically the bank is giving you an encouragement by raising the rate of interest. You give a second thought. Hey, when you are taking 10 euros out of your pocket, you say, hey, should I consume it now? Or should I consume next year and get 4% rate of interest from the bank? You know, there is an opportunity cost. If you consume today, you are foregoing, you're sacrificing the rate of interest. And that rate of interest, if it is too low, you don't bother. But if it is very high, you bother. Okay? And or if you are willing to sacrifice your current consumption because the rate of interest is very high, then you do it. Look, in a way, it's not forcing, but in a way it's forcing. For example, when after Christmas thing, you know, in January, when you go to a store You want to buy the grocery, but suddenly you find that there is a prices are 50%, 60% lower on clothes, on shoes. And you decided that you will go to the grocery, to Prisma, K Market, only to buy some yogurt and milk and eggs and bread. And guess what happens? You go that side. So it's the same way. It's same, the allurement. So the central bank can also allure you by changing the rate of interest. Yeah. So this is how it works. Any other point? Yes, Salad?
I have some kind of a historical example.
Now I need to go back to the slides. There's no question from our online friends. Please feel free if you have any question to ask me. Okay. Very quickly, I want to use the two words, the last at the here. I use the word qualitative and quantitative easing, yeah? Okay. The qualitative easing is that when the state wants to create more money supply, okay, so that it should have more money, it should give you more money, you spend more money, but the state wants to discourage you from certain spendings. Do you get my point?
So the government wants us to save money.
No, I want that you have money, you consume, you invest, whatever you do. But if the state wants that, hey, don't buy anything which is containing carbon or containing environmentally hazardous elements. So in that case, the central bank can be more choosy that, hey, this money, we make this quantitative easing. Quantitative easing is, for example, I am the central bank and I think you have less money, so I buy assets from you, I give you money. This is non-discriminatory action. But if I discriminate, that I'm only buying those bonds from the people, which people have invested only in the eco-friendly technology, not for others, then it becomes qualitative thing. Quality means discrimination, when you make some discrimination for one sector but not for the other sector. And why would you do this discrimination? Because you want to encourage some activities in the economy and you also want to discourage some activities in the economy. For example, if you go to Bank of, I had a chat, very long chat with the manager of Nordea not long ago, and he said to me that they have almost stopped giving a single euro loan to any investment project which is leading to environmental damage. But then they were very open to give loan for other investments. If you want to buy a house, they're fine. But if you are going to take some project which is involving pollution or some kind of health and safety problems, then they say no, we say no. Now this is called qualitative easing, that you are encouraging one sector, but you're discouraging the other. That is called qualitative. But the example which I gave you before, that the Bank of Finland buys bonds from you and it gives you money without asking you where to spend, where not to spend, it is called quantitative action. But if the state is encouraging you and discouraging you for something at the same time, then it is called qualitative easing. In one case, they're offering, the state is asking, hey people, come, give me money. I give you 3% rate of interest. And then the same time, state is saying that, hey, if you want to give me money for this purpose, I give you 1% rate of interest. It means I'm discouraging one type of investors. Okay, and what to encourage, what to discourage, it depends upon the state's priorities. It depends upon the state's requirements. If I'm the head of the central bank and I find that if there is too much money supply in the economy, people not buying goods made in Finland, hey, they are buying goods from other countries, then I have to think something, that I give choice to people to have more money so that they can buy, but at the same time, I will try to put some mechanism that they don't buy imported goods, they buy made in Finland goods. Okay, so when you have this kind of ideas in mind, when you are discriminatory, then we call it qualitative easing. Make sense? Any question? Any thoughts?
So what's actually the difference between quantitative and qualitative?
Well, I gave this example, but I can give it again. That if I'm the head of the central bank, and I think that my people and the companies, they should have more money supply. Like, for example, we saw from the Suomi Pankki's website, they want to give 60 billion, 80 billion this year, right? But if they put conditions to it, then it becomes qualitative easing. Conditions mean that this extra money which I provide you, you will not spend on goods made in those countries where there is no democracy, or where the labor laws are not followed, or where the goods which are made of hazardous chemicals, or the goods where the child labor is involved. So when you are not only giving money to people, expanding the money supply, but also telling people what to do and what not to do, then it becomes qualitative. In the quantitative, I don't care. I either increase money supply or decrease money supply. It's up to you. But when I'm also acting like a big brother and telling you what to do, what not to do, then it becomes qualitative easing. Yeah, make sense? Mm-hmm. Okay. No worries. So the next thing is the interest rate or the collateral requirements. The interest rate and the collateral requirement is not involving any market operations. It is a two-tiered relationship between central bank and the commercial banks. You know commercial banks? Can you name some commercial banks in Finland? Osus? Any bank in the high street is a commercial bank. Handelsbank, Danske, Nordea, Osus, and any other bank? S-Banki, yeah. So all these banks, these are the commercial banks. And here there is no market mechanism of bills or the bonds, no. The central bank sitting in Helsinki, they decide that, hey, you know what? We should discourage people from borrowing, because people are borrowing a lot of money and they're spending, and that is causing inflation. Then what happens? Then the central bank says to the Nordea, hey, tomorrow onwards, anytime you come to me and ask for more money, I would charge not 1%, but 2% from you. Remember, the banks borrow from the central bank. Like we borrow from the commercial banks, the commercial banks borrow from the central bank. This is why I'm saying two-tiered relationship. And if it's like a you buy milk or yogurt in Prisma, you pay the retail price, and then the Prisma buys the same thing from supplier, and they pay the wholesale price. You know the wholesale retail price. Okay, so the same thing happens. If tomorrow Nordea is borrowing expensive from the Central Bank of Finland, then Nordea will also increase its rate of interest when people borrow from it. And then people would be discouraged from borrowing. And when they're discouraged, there is less money supply in the economy. They would rather save. So not only they are discouraged from spending, but they're also encouraged to save. Can somebody tell me why it will work two ways? That on the one hand, they are discouraged to borrow, and at the same time, they are encouraged to save. Can somebody elaborate my statement?
You won't take money from the bank.
Because it's expensive to borrow.
Yeah, because it's expensive to borrow. But on the other hand, if you give money to the bank, they will.
You earn more interest.
Yeah, you will get more money.
Bravo! Exactly. This is how it works. So you are killing two birds with one stone. I was going to say killing two stones with one bird. Well, the bird must be made of stainless steel then. So this is how you work. That on the one hand, you're discouraging people to borrow because you guys are willing to borrow money from me, and you guys were having surplus money, but maybe you were spending money wastefully because the rate of interest was low. But now, when I raise interest rate, you guys straight away stop borrowing more, and you guys don't indulge in wasteful consumption. You rather keep money with me, and I give you more interest, isn't? On the contrary, if the central bank executives in their board meeting, they decide that I think we should increase money supply in the economy, like they have decided that they would have this debt purchase program, assets purchase program, as you saw on the website. So then what they will do? The central bank would charge low rate of interest from the high street banks, and the high street banks would charge low interest from its customers. You borrow more, yeah, because it's cheaper. You save less. And when you save less, what would you do? Spend money. And that's what I want. That's what I want, that the level of economic activity should be promoted, encouraged. And how do I do it? By lowering the rate of interest. Now you will borrow from me because now you think that, hey, the rate of interest is low. You can buy an apartment. And you guys think that, you know what, it's not worth keeping money in the bank. They don't give anything. Okay, let's invest in stocks, or let's spend some money. Let's go on holidays, whatever you do. Yep. So this is how the interest rate work. And sometimes the bank do not change interest, but they can also change the collateral condition. You know collateral? Have you heard this word collateral before? Collateral. Okay, because I distinguish you that you guys are borrower and you are saver, right? If you want to borrow money from me, and let's say I'm heading Nordea Bank in city center, how our deal would be taking place? What would we do? You come to me, you say, Shab, give me, I'm seeking 200,000 euros loan because I want to buy a house. And I say, okay, fine. I check your credit report. You're fine. You have fixed salary, regular money you get. You have not defaulted in the past. Okay. I charge 2% rate of interest from you. And you say, fine, I'm happy with that. Is that enough to make a deal? Or something else is required? Yeah, anybody? Sorry?
I think a collateral.
Collateral, that's my point. What is collateral then? The collateral?
Something of value that you can present.
Some security, something, okay? Now what happens? That now the seller of the house is there in the bank office. So three of us, you are the buyer of the house. The seller of the house also comes there, and I'm the banker, okay? Then we go in a small cabin, and I offer you coffee. Great, congratulations. And then he or she signs a paper You also sign the paper. Now the house belongs to you. But just when the seller of the house is transferring the papers to you, I take them away. And I say, hey, I keep it with me. Because who knows, you don't pay me. So this is called collateral, security. I want to cover myself. I'm a banker. Come on. What if you default tomorrow? Yes. That's called hedging, risk, as you said, risk management. So I want to cover my risk. And this paper would remain with me till you pay the last installment of your loan. And we make a deal that you pay loan in 15 years. All right, 15th year, you come, you pay your installment. Okay, congratulations. Sorry, you have forgotten your papers. Good luck. Take them with you. Yeah. So this is called collateral. And if I want to encourage people to borrow more from me, then I can, in certain circumstances, I can even waive the condition of collateral. That, hey, I don't think. Okay, you bought a house. In the example, I'm taking 100% collateral. The entire paper of the house, 200,000 are with me. Okay. In certain cases, I can say that, all right, keep the papers with you. Give me something else. Which could be even 50% or less than 50% of the total value of the debt. Something like that. Or I can completely write off the condition of this collateral. So collateral makes your loan process simpler. And if I waive this condition, you feel less pressured. Because otherwise, you own the house, but papers are with the bank. That is called collateral. So by making this collateral strict or lenient, bank can encourage or discourage people from borrowing. Collateral basically means security, deposit, or some kind of, what could be the word? Maybe it sounds more like a insurance, yeah. As a bank, now I'm insured that if you run away, you don't pay the installment, okay, all right, I give you notices, you are not replying to my notices, 6 months, 7 months, okay. In the exceptional cases, I say this person has defaulted, bank can sell the house and recover the cost, recover my debt. Yeah. Any question about second point? Yes, sir.
Okay, not sharing your screen.
Oh, you didn't. You should have said. My apologies, because I'm moving between different things. So sorry. In the future, if there is any, if I forget, please drop a message in the chat that I am not sharing the screen, and I would do it. Sometime I go with the flow and I forget. Any question about number 2 point?
For example, the loan is not so high.
You're right.
If you're loaning just 2,000
Yes.
euros, you are not loaning like
Yeah.
million or something.
Yeah, you're right. I'll tell you something. If you are a startup company, right, you're not buying the house. Remember, house buying is a consumption, right? Let's say you are an entrepreneur and you register yourself as an entrepreneur and you go to the bank and the bank says, all right, we deposit 10,000 euros in your bank account and we will not charge any interest from you. Why the bank is giving you this 10,000 euro in your bank account? So that you can start your business. It's like a seed money. Means because when you start your operation, you might have to pay a supplier, you might have to buy some designs, you have to buy your laptop even, yeah? So bank says, to make your life easy in the beginning, I give you 10,000 euros and it's not a big amount, okay? So in that case, the bank can deposit this money with you. We call it CC, cash credit, which means the bank wants to make life of the businesses easy by letting them borrow up to a certain limit. without any interest, without any collateral. And as your company becomes bigger, you were a startup, now you have 50 employees working with you. You are now selling a couple of millions goods worth abroad, right? You have an operation in Uvascula, and now you have new unit in Tampere. Business is growing. Then this CC limit will also expand in relation to your success. Okay, so that is also possible that the bank gives you this cash credit limit in which there's no collateral.
And I would like to borrow 5 million euros for investment in business of a particular country where I would like to receive a citizenship.
Oh, that's...
So what would be a collateral?
Yeah, you're making it very complicated. Well, sorry, can you say it again? So let's say you're living in Finland. Okay. Well, it depends. First of all, the collateral depends on from which bank you borrow. Are you borrowing from the Finnish bank? Well, in this case, I think the Finnish bank can insist you that when you buy the house in Spain, you give the documents, and the Finnish bank can be in touch with your Spanish bank. After all, if you have a house in Spain, you will be having a Spanish bank account also. So maybe the Finnish bank can insist its Spaniard colleague that when the deal is done, the document should be given back to the Finnish bank.
If you are buying some mortgage in Spain, you will receive citizenship only within 10 years. But if you invest, it's like a rapid process of.
Yeah, but okay, if you invest in Spain, then the banking institution in Spain would ask you where this money come from. In Spain, I think it's only in Panama or in some strange islands. There's all Saint Lucia and all that stuff where when nobody bothers, or Bahamas. In most of the countries, when you are a foreigner or even local, when you want to buy some assets, especially the land or these kind of things, they want to check your source of money. And if you want to buy a house in Spain, after all, you will pay cash to a Spanish house seller through the bank account. Okay, and so it means you must have a bank account there. And when you have the bank account there, it will be very clearly mentioned that this money which you're giving to some Rafa Nadal is basically has come from the borrowing from the Finnish bank. And then the bank, because bank-to-bank connection is very strong, okay? And this is done by, in case, this is a little bit off the topic, but there is a bank called BIS, Bank of International Settlements. It's a wonderful website. They have lots of data. BIS. The Bank of International Settlement is a platform where all the banks are interconnected. So you can't take money from the one bank and deposit in the other bank, and the other bank doesn't know that where the money comes from. It's not possible. So all the banks all over the world are connected instantly. They get the wired message instantly. And by the way, every day, 2 to 3 times, they check that how much money a bank owes to another bank. In this example, that you take loan from the Finnish bank and you buy a house in Spain, basically, when you have a bank account in Spain, it shows that that money which you are using belonging to the Finnish bank. So basically on that day, Spanish bank owes some money to the Finnish bank. And this they know immediately when you do the transaction. Okay, so it's not so easy. don't try this. Don't try this. Mm-hmm.
So, for example, if you invest in governmental securities, is the system the same? Like the bank takes the securities from you if you don't pay the loan?
Yeah. If, for example, yeah, that's a good example. If I'm buying the securities issued by the Bank of Finland, and to buy them, I'm using bank loan. So, for example, I take loan from Nordea and I buy the bonds issued by Suomi Pankki. Well, in this case, when I buy those securities, they would lie with my bank. So, bank have a claim on it. So it's not just the building or the fixed property, even these financial assets that we buy, even that has to be, bank has to, as you use the word, bank has to cover its position, risk management. Okay? And they're very smart people, so they know that where is their risk. Yeah, but I'm very happy that you're asking questions. So as I said, it's a very applied economics topic. Any questions? Any more comments or any? I can't see the watch here. Okay, but okay, now I remember. Yeah, now I can see here. The next point which I want to discuss with you is the third point, which is change in the reserve requirements. Change in the reserve requirement, this information is also on the Bank of Finland's website, which we discussed. You can check it, or I can show it to you afterwards. The reserve requirement is that let me find some example. Let's say, once again, I'm central bank based in Helsinki, right? The Nordea bank comes to me and says that they need 100 euros. I, central bank in Finland, I give them 100 euros by transferring to their bank account. And then I say that, hey folks, Mr. Manager of Nordea Bank, remember that the reserve ratio is 10%. Reserve requirement is 10%. 10% means the money which I gave you, you must keep 10% with you. And the 90% you can give in the form of loans. Are you with me? So it means that when I give 100 euros to Bank of Nordea, the Bank of Nordea cannot give loan worth 100 euros. Maximum it can give 90 euros.
If the bank goes bankrupt, you will still have at least those 10 euros. Well,
that's a different story, but basically I want that the bank must maintain liquidity, cash with them, so that they can, if I give money to the banks, I mean the central bank, and they keep giving all the money to the customers, then many customers would default. And if they default, the banks will collapse. So I want that the bank should be having some kind of surplus with them. And if I want to become more expansionary, expansionary means more money supply, then I would reduce this requirement from 10% to 5%. So instead of 90 euros, Nordea would be having a capacity of 95 euros to give loan to the bank. Yeah, make sense? And if I want to become strict, less money supply, controlled money, not less, but controlling the money supply, then I would raise this ratio from 10% to 15%. It means now tomorrow, Nordea will not be able to generate 90 euro loan Max, it could be 85 euros. Make sense? So by changing the reserve, you can encourage or discourage. Remember, it's not in a way, it's not a pressure, but in a way, it's a pressure. It's not a compulsion, but it's more like a pressure on you. So you are putting the pressure on the bank, either to increase loan or to decrease loan. Sounds good? Okay. Now, if I become a little bit tricky, remember the example of 10%. Now, keep in mind 10%. And let's say Vlad is the manager of Nordea Bank. And I say, Vlad, I'm transferring 100 euros to you, and the reserve requirement is 10%. Vlad, how much money you can give to the borrowers next day? 90 euros. Okay. And then you say your name again. Huh? Fernanda. So she comes and she borrow from Vlad, she borrow from you 90 euros. You give her 90 euros by transferring to her bank account. Okay. Now, how much money you have now? 90 euros. And let's say, sorry, what's your name, gentlemen? Huh? Huh? Tony. And you owe 90 euros to Tony. And you transfer to his bank account. How much you transferred? 90 euros. Tony, you have your bank account in Danske. And what's your name? Stefania is a manager of Danske Bank. Stefania, how much money you get? 90 euros. And what is the cash reserve ratio? Yeah. What is the reserve requirement in this example? 10%. What is 10% of 90? 9. How much money you can give loan to your borrower? 81. It means if this lady who's sitting next to you, what's your name? Leda, if she comes to borrow from you tomorrow, the maximum loan you'll give her 81. And this is how the money flows in the economy. Can you see here? I ignite, sitting in Helsinki, Nordea, customer, another customer, Danske, a customer, and then this customer gives money to Yanni because she owes you and she gives you 81 euro, right? And you have this bank account in Handelsbank. And the lady who's sitting next to you is the bank manager of Handelsbank. And then she will keep 81 euros, but she can't give 81 euro as a full amount to the borrower. She would keep 10%. And why this is 10%? Because I said every time anybody, any bank creating money in the economy, keep it 10%. And if I increase this ratio from 10 to 15, guess what? The money which he can give to you, the money which she can give to Leda, and the money which you, the manager of which bank? Handelsbank can give, the money would go down. Can you imagine 15%? And if you want you guys to encourage more money supply in the economy, then I would say no 10%, 5 is enough. Now you can borrow 95, not 90. Okay, this is how the money circulates in the economy through the mutual. Yeah.
Or it is constant.
No, it can change in the middle of the process and it would affect you. Yeah. So it can affect you as well. Yeah. It doesn't change every day, but it can change because because if the Bank of Finland keeps changing every day, then it will be very economically uncertain atmosphere. Okay. The last thing the central bank would want is an uncertain economic atmosphere. So they rather keep it stable and constant for some time. Of course, if there's too much of inflation in the economy, which means too much money there, then they would raise the cash reserve ratio. And if the factories are closing, people are not using money, I mean, it's a very recessionary situation, then they would go put it down. So, yeah. But they don't change it on on daily basis. Okay. I hope it makes sense. So this is called the reserve requirements. So by using these channels, the central bank of the country can change the supply of money. But supply of money can be changed, but at a given point of time, the supply of money is constant. I mean, we know what is money supply now. We can see the data. But at a given point of time, if you see in the short period, the money supply is fixed. But if you see it over a long period, then money supply would change accordingly. And these are the three main mechanisms, tools, methods through which the central bank can change its money supply. And these are, I repeat, open market policy. The central bank wants more money with you. It buys financial papers from you and give you money. Second, reserve requirements, the interest rate. If the central bank wants more money in the economy, reduce the rate of interest, and vice versa. If central bank wants to have more money in the economy, reduce the reserve requirements, and vice versa. So these are the three commonly used methods which the central bank economists use it quite frequently to alter the money supply. And that's it for today. Okay. One very important announcement which I want to make